Hello and welcome to part 2 of this series on financing by Property Profits Real Estate Business Building, where we help you grow a real estate business, not just a portfolio. My name is Gord Lemon and I've been involved in Canadian and US real estate for over 26 years. I've also helped many people build their real estate businesses as a real estate entrepreneur coach and speaker, and I'm also a published author with many real estate articles in various publications. As this video has some information which may be content and time sensitive, it's important that you pause the video and read the disclaimer prior to moving on. Real estate entrepreneurs must be in full knowledge of the financing process, the options available to them, as well as to their joint venture partners. Let me ask you a question. Is it better to be suggesting the type of mortgage you need, the terms and the type of lender, than going to a bank or mortgage broker and being told what you can get? You must be in control, working with your financier to get your deal done. This requires knowledge of terms, mortgage products, and lenders. And this is part of your language as a real estate entrepreneur. In the first part of this series, we discussed loan-to-value, down payments, high ratio and conventional mortgages, as well as mortgage insurers. Let's move on to the process of mortgage qualification. The first part of mortgage qualifying yourself or for your joint venture partner is called income qualifying. Lenders love employed individuals. The longer and more secure the vocation, the happier the lender is. Teachers, healthcare professionals, and unionized workers seem to be on the top of the list for most lenders, even though there isn't an official list. There are two main calculations which are significant in the income qualifying process. The first one is called Gross Debt Service Ratio, or GDS. This calculation allows the lender to understand if you can afford the new mortgage payment you're about to take on or not. For them, it's all about making sure you can pay. Based on the down payment and consequently the mortgage amount, they figure out, based on the rate and amortization, what your monthly principal interest payment will be. They go on to add the monthly property taxes and then an amount for heat. Yes, heat. Because in Canada, our houses need heat, at least part of the year. So there's an arbitrary number of $100 per month added to this calculation. This is then added up and divided by your combined family income. So let's do an example. Let's say the mortgage payment is $2,000 per month, which is a combination of principal and interest. We then add our property taxes, which will say are $3,000 per year or $250 a month, and then we add that $100 for heat. We'll say our combined family income is $60,000 per year or $5,000 per month. Now, if we do this calculation, we get 47%. Now, lenders want you to be under 32%, which means they're uncomfortable when anyone is spending more than 32% of their income to their housing. So this can go two ways. Either the property amount and therefore the mortgage amount needs to be less, or this person needs to make more money. So let's go with the former. A less expensive property and a mortgage amount, we will try, say, $1,300 as a mortgage payment and $200 for property taxes. And of course, we can't get away from the $100 of heat, so we'll keep that. And if we use the same income amount, when we do the calculation, we actually get exactly 32%. This is the highest mortgage amount this person can qualify for through an A lender. Some B lenders don't consider this calculation, and actually most private lenders don't consider this calculation at all. The next calculation that most lenders will use is the total debt service, which is a really significant qualification factor as it combines the gross debt service calculation with all your other monthly obligations. This is called the total debt service ratio, or TDS, or TDSR. So you have your principal and interest, which is your mortgage payment, plus the property taxes, plus your heat. We know this already, but they will also include the principal, interest, taxes, and heat payments from any other properties that you own. We now add all our other monthly obligations, such as credit cards, lines of credit, loan payments, such as student loans or car loans, and then any leases, such as a car lease. Now, if you wonder where they get this information, well, it's provided on your credit bureau. So the calculation adds all these monthly obligations and divides it again by your combined family income. So shall we try an example? So we have our mortgage payment of $1,300 plus the $200 property taxes and $100 for heat. So we're going to add a $250 credit card payment, a $150 line of credit payment, a $125 student loan, and a $325 car payment. And this is actually pretty conservative for most families these days, but let's just see what happens. So when we do this calculation, we get $2,450 over our combined family income, which gives us 49%. Now, lenders like somewhere between 40 and 42%, depending on their underwriting policies. This means the applicant in this case must pay off a couple of these debts fully in order to qualify. By a simple calculation, if the applicant paid off the credit card, the line of credit, and keep the student loan and the car payment, we would have $2,050 over that $5,000 monthly income. And so the person would actually have a TDSR of 41%, which for most lenders would actually qualify. Well, that's all the time we have for now. Join us for the next video in this series and get lots more tips and strategies at CanadianREJVClub.com or www.propertyprofits.ca. Thanks, and we'll see you next time. Bye-bye.